Hello, and thank you for joining today's Tax Insights live webinar, our second one of 2026. And today we're going to try a slightly different format. So today's session is less of a technical update and more based around risk and what that means for advisors. So I'm really interested in your feedback. So please do let me know after the session your thoughts, whether you like it, or if you're a regular attendee, whether you prefer the more technical update. Really pleased to hear your feedback. So I'm going to start with an observation. So in 2026, when clients look at UK tax policy, they see relative calm. There's no emergency budget. There's no dramatic headline tax rate increases. There's no fiscal shock reports in the news and so on. And that perception of calm is what makes 2026 actually really interesting, because beneath the surface, the tax system is tightening quietly, and that's almost more dangerous than loud reform, because the risk is that clients and advisors don't respond quickly enough because they don't perceive that there are big structural changes happening. So today is not going to be about reciting tax rates and teaching you calculations and so on. It's going to be looking at where risk is accumulating inside the tax system, what that means for advisors, and how we can help our clients. So why are we even talking about this if you're not tax advisors necessarily on the call? So, I mean, we've all seen the headlines, haven't we? I've grabbed a few here, recent headlines. It's very much under scrutiny, isn't it? And not all of these headlines are issues caused by tax advisors. There are other professionals who've been involved, and there is a risk to everybody if there are tax issues that perhaps should have been identified, referred to a specialist, and weren't. So at a macro level, the forecast from the Office of Budget Responsibility, the OBR, shows tax receipts as a percentage of GDP remaining elevated. And that's not because rates have surged dramatically, because they haven't. It's because thresholds are frozen and the tax base has therefore widened. And the policy direction from the Treasury has leaned heavily on freezing allowances rather than increasing rates. And at the same time, enforcement capability within HM Revenue and Customs has increased. So we have a combination of static thresholds, rising incomes, and we're going to look at the impact of that in a moment, greater digital reporting, data matching, and obviously we've got the impact of AI on HMRC, and other governments around the tax authorities around the world are more able to mine data to spot trends and to find problems. And that combination creates pressure quietly and perhaps without the dramatic headlines that we sometimes see when we have things like rates going up. The basic rate band remains at £37,700, when the higher rate threshold at £50,270. And the freeze of these thresholds will continue until 2031. So we've got a slide in a moment that demonstrates the impact of that. But you can see that already the combination of these things means that although there's no headline announcements about shocking rates of increasing rates of tax, there are pressures building behind the scenes. And the themes that we're seeing in 2026, the key structural themes are fiscal drag, which we've just talked about, relief vulnerability, looking at the tax reliefs that people most commonly take advantage of and whether they are politically vulnerable, whether they are likely to be targeted by this government or a successive government. And then we've got administrative tightening as well, the increased enforcement by HMRC, the increased capability, the use of AI to find more underpayments of tax, identify them, and increasing collection as well. And these are not temporary changes. These are major structural changes that aren't going to go anywhere. And that structural change impacts on legal drafting, accounting modelling, financial planning, all at the same time. So you can see already that it brings in lots of different advisors. It's not just tax advisors that are impacted by this. And if you understand those three key themes of 2026, you understand the direction of travel and therefore why and how we can help our clients. So looking at that fiscal drag point in a little bit more detail. So you can see the graph here. As I've said, the personal allowance is frozen at 12,570, and that's going to be the case up to 2031. And you can see over the last few years, the average income has increased, but the personal allowance has not increased at all. So clearly already we can see more and more people being pulled into higher rates of tax. So people aren't necessarily paying a higher tax rate, but they have less money in their pocket. The line chart shows the dynamic. When wage trends go upwards, allowance stays flat. Clients don't feel like tax has gone up, as it were, but they feel poorer. They have less money in their pocket. And that has implications, doesn't it? Shareholder remuneration might need recalibrating. Partnership distributions might create unintended spikes in income. Employment negotiations are more tax sensitive. Bonus structures, again, more tax sensitive. Divorce settlements have to account for distorted net incomes. So this fiscal drag does change behaviour, and clients don't always necessarily realise that's happening or realise why. So if modelling assumptions were built, say, 4 or 5 years ago as part of a planning exercise, they're likely to be inaccurate and out of date now. And that gradual distortion is harder to pick up on and harder to respond to in a timely fashion than sudden change. We've spoken about marginal spikes, and now we move into something even more visible. So between 100,000 and 125,000 of income, the withdrawal of the personal allowance creates an effective marginal rate for individuals of 60% rate of tax. So you've got 40% higher rate tax plus the taper effect of the withdrawal of the personal allowance means that individuals in that tax bracket are going to be effectively paying 60% tax. And that's before we even think about pension tapers, child benefit withdrawal, loss of tax-free childcare, and so on and so forth. So the problem is that this creates distortion in terms of behaviour. Clients often make suboptimal decisions. They will decline bonuses because they don't want to move into that tax bracket. They'll structure remuneration poorly. They don't really understand quite why it is that they have so little money left compared to what they were expecting, which is dispiriting. They try to defer income. They might want to make pension contributions because they've heard that that's worthwhile, but then they might create an issue with a pension taper. There is a risk that people will attempt accrued and potentially unlawful income shifting arrangements. And people are quite likely to restructure their affairs, restructure dividend receipts, for example, tax inefficiently. So it does drive quite significant behavioural change, not necessarily in a good way. So if profit extraction strategies, remuneration strategies haven't been reviewed for some time, they really should be now. So for accountants, that's modelling work, working with individuals and modelling their income and what is the impact of that pay rise, that bonus, etc. For lawyers, it might affect shareholders' arrangements, service contracts, bonus schemes that they're drafting. And for financial planners, it might affect long-term modelling, cash flow assumptions, and so on. So you can see it does impact lots of professionals. It's not just about the tax advisors again. The next trend we're going to look at in 2026 is reform sensitivity. So capital gains tax hasn't dramatically increased, but relief generosity has decreased in recent years. So the annual exemption is smaller than it used to be. Business asset disposal relief is still available, but it is a much lower level than it used to be. It was reduced in 2020 from £10 million lifetime allowance to £1 million lifetime allowance, so a really significant decrease in recent years. And I'm not necessarily forecasting any further changes to that. I don't know what's going to happen, but reliefs that are valuable, that are visible, that are seen to incentivise people who have made a significant amount of money are politically vulnerable and sensitive to reform. So we need to be aware of that. For transactions advisors, this introduces sensitivity around timing. So is 2026 going to be a holding year, or is more reform on the way? And if clients do delay exits by 2-3 years, what difference is that going to make? Is it going to mean that they fall into higher tax brackets? So when we're advising on things like earnouts, deferred considerations, pre-sale restructurings, management buyouts, succession planning, we need to bear in mind that reforms, that reliefs are sensitive. Reform may be on the way, although we can't predict what's going to happen, and just be mindful of that when we're talking to clients about the future. Another trend we're seeing in 2026 is inheritance tax creep. Inheritance tax used to be seen as a niche issue, and it isn't any longer. The nil rate band has been frozen for years. Asset values, particularly properties, trading businesses, have increased. Therefore, more estates are drifting into being captured by inheritance tax. So family companies, trust structures, agricultural holdings, so even if rates don't change, exposure increases because that nil rate band has been frozen for some time. So this affects the advice that we give. Again, it affects share structure design. It affects succession planning and timing. It affects trust planning and lifetime gifting strategies. Again, this is all cross-disciplinary, isn't it? You can see here there's accountancy, there's law, there's financial planning, and obviously there's tax advice. So in terms of a trend, we need to be aware in 2026 that more and more estates are going to be creeping into the inheritance tax net. So bringing some of these things together into a case study. So let's say we have a £4 million trading company owned by a husband and wife. They're thinking about selling it in 2 to 3 years. They've got 2 children who are entering the business. Their combined income is 180,000, and their extraction strategy hasn't been reviewed recently. So what could possibly go wrong? On paper, everything looks fine, doesn't it? Pretty standard. Husband and wife own a business, children might be coming into the business. But if everybody's affairs and their tax matters haven't been recently reviewed, what do we risk? Fiscal drag increases the personal tax exposure. So that 180,000 that they're taking out of the business is going to be eroded. Essentially, what they end up with is going to be eroded over a period of time. Potentially, the pension taper could be triggered and reduce the efficiency of the arrangements. Capital gains tax exemption reductions affect the disposal modelling. So if the exit modeller was made when those capital gains tax exemptions were at a higher level, they won't be accurate anymore. Inheritance tax exposure potentially increases as the value of the business rises, and timing sensitivity emerges if reliefs change. So the risk is that we look at this from a siloed perspective. So the accountant sees inefficiency in the extraction of profits and deals with that. The lawyer looks at share structuring and exit readiness and deals with that. And the planner sees potential pension taper, waste, intergenerational timing risk, and so on, and deals with that. But if those conversations all happen separately, then the risk is that value leaks out of the business and the optimum result is not achieved for the client. Whereas if they happen together, then planning accelerates. So a key point here is around joining up the advice. And in 2026, we really need to be making sure that our advice is joined up between advisors. So we talk through here the potential risks of cross-professionals looking at this in silos and not working together. So in terms of putting some numbers around the exit timing that we've talked about, we're going to have a look at some numbers and look at the business asset disposal relief. So for those who don't know, business asset disposal relief allows a lower rate of capital gains tax on the first £1 million of capital gains, qualifying capital gains in a lifetime. But we're going to look here at the impact of the change of rates. And this change of rate has already been announced. This really is happening. But obviously, the point is wider, that we're talking about sensitivity to changes. So in this scenario, we have a single shareholder who is making a £4 million disposal of shares in a qualifying trading company. And they still have their full £1 million business asset disposal relief lifetime limit available. The remaining £3 million will be taxed at the main capital gains tax rate. For this purpose, we're going to ignore the £3,000 per year annual exemption, because for the purposes of this illustration, it isn't relevant because it's so small to not make a material difference to the numbers that we're talking about. So if this sale happens before April 2026, when the rate of business asset disposal relief is 14%, the first £1 million of the gain will be taxed at 14%, which is £140,000. The remaining £3 million will be taxed at the full rate of 24%, which is £720,000. So the total capital gains tax payable will be £860,000, and the net proceeds are therefore £3,140,000. If that sale takes place after April 2026, when the business asset disposal relief rate is changing to 18%, that first million, instead of being at 14%, is going to be at 18%. The remaining 3 million is at 24%. So the total capital gains tax is £900,000, and the net proceeds 3.1 million. So the difference just from that 4% business asset disposal relief increase is £40,000 just because of timing. So obviously, structural sensitivity. You might say it's only £40,000, which in the context of a 4 million disposal is not particularly significant. But it may not sound dramatic, but that's only from the business asset disposal relief slice. There are some important things to note here. The business asset disposal relief does not scale. So it's still £1 million if that's an £8 million disposal, a £12 million disposal, etc. So the exposure to the main rate doesn't scale. So the larger deals are mainly taxed at the higher rate. There's no increase in the business asset disposal relief rate for a larger deal. And also, obviously, we've used this change in business asset disposal relief as an illustration, but that's not really the risk that we're talking about. The risk we're talking about is structural sensitivity. So if the main rate moved from 24% to 28%, obviously that £3 million at 28% becomes £840,000 instead of £720,000. And therefore the total tax is £1,020,000. Now we're £160,000 worse off than we were compared to the pre-April 2026 position. So you can see, obviously, our illustration, the numbers may not be huge in the context of the 4 million disposal, but the point we're making is the sensitivity to not just the bad relief rate, but actually the main rate of CGT as well, because of the vast majority of the proceeds falling into that main rate band. So the message here for advisors is not, rush everyone to exit before April, because obviously now we're mid-February. That's not practical anyway. But the lesson is people have to be aware that the vast majority of proceeds sit at the main CGT rate. So actually that sensitivity to that and keeping an eye on what happens with that rate is the dominant question rather than business asset disposal relief. So future main rate changes are more important than bad relief tweaks. Retained earnings strategy matters. How much do we leave in the business? How much do we extract? How much, and how do we structure that? Pre-sale restructuring matters to make sure that we're getting the optimum tax result. And the consideration earn-out, how much is consideration for the shares and how much is paid for any services after the sale or in terms of an earn-out also matters. It's becoming more and more important. Exit timing is not neutral. We've got change already announced. We don't know what's going to happen in the future, but the key takeaway is timing is really key. So we've talked about exits for individuals, but what about corporation tax? So in 2026, we do have a 25% main rate of corporation tax. We have a 19% rate on the first £50,000 of profits. We have a 25% rate on profits over £250,000. But we have another tax trap here, whereas earlier we talked about the 60% trap for individuals. Here we have a marginal relief trap for companies. So the effect is that profits between £50,000 and £250,000 are effectively taxed at 26.5%. And for those of you who do like the maths and see how this all works out, I've actually put a calculation on there. We deduct marginal relief, but then we end up with that zone in the middle where profits between the 50 and the 250 are taxed at 26.5%. So there's a trap to be avoided there when planning remuneration, because this will affect salary payments, it will affect bonus payments to try and ensure that profits are ending up at the expected level to get the tax result that company owners are expecting and wanting. And the really important thing here is that whereas we've said that profits up to £50,000 are taxed at 19%, profits over 250 are taxed at 25%, those thresholds are divided by the number of associated companies. So associated companies are, very broadly speaking, companies under common ownership. Essentially, it's obviously more complicated than that, and we're not going to go down that rabbit hole now. But if you've got an individual or a couple or a group of individuals owning a number of companies, the associated company rules would need to be reviewed, because it's likely that those thresholds might be divided by the number of trading companies, and therefore companies can be pushed into higher rates of tax at a much lower profit level than they are actually expecting. And this has been a huge issue for accountants and tax advisors. We have lots of people who are coming to us, and they've got groups, and they've divided the trade into lots of different companies. Perhaps they've got companies that aren't really needed, but they just haven't really streamlined. And depending on how the numbers work out, it can mean that actually the group overall tax exposure is higher. So it can often be advantageous to do a streamlining exercise to reduce the number of companies, consolidate things, and therefore bring down the group overall tax exposure. So again, this isn't about any kind of aggressive planning. It's about awareness of the direction of travel, the traps that companies might fall into, and about modelling for the future. So looking at, okay, we might be paying 19% now, but what's going to happen next year, the year after that? Are we going to eventually end up being pulled into that 25% main rate, or even the 26.5 marginal zone trap, when actually, if planning was done and modelling was done earlier, that could be avoided. So we mentioned at the beginning, when we talked about the direction of travel for 2026, about the administrative landscape. So digitalisation continues under the Making Tax Digital requirements. That has been pushed back, but it is still happening. So more administration, more quarterly reporting, and of course this gives HMRC more information with which to open inquiries and to pursue what they perceive as underpaid tax. Data analytics are constantly improving. HMRC have ever improving tools at their disposal, including but not limited to AI tools, and they are using them to ensure that again, any perceived underpayment of tax is pursued and is called in. Penalty regimes are becoming more automated. There is less discretion, which might mean that clients are unable to perhaps argue their case to pay a lower penalty or a mitigated penalty than they perhaps might have been in the past. And this means that professional risk changes and shifts. Engagement letters need to be tighter. What is the scope of this engagement? So, for example, if we're doing a piece of work on, an element of an aspect of corporation tax, should we be looking at that group structuring, as we've mentioned on the previous slide, to make sure there aren't more companies that are needed, and therefore more tax being paid at the higher rates. Scope clarity becomes really, really critical, because the more complex the landscape, the more risk there is that a client thinks that we are covering something we're not covering, or other professionals think we're covering something that we thought they were covering. Things fall between the cracks, don't they? So scope clarity becomes really, really important. Reliance disclaimers, again, take on a new importance. Who is actually allowed to rely on the work that we have done, and for what purpose? We're doing something for a client, and then a bank, say, decides that that they're relying on it. To be really clear about who's entitled to rely on the work and what they're actually using it for. And cross referrals become even more important. So we've talked several times, haven't we, about the interaction between the accountants, the lawyers, the tax advisors, the financial planners, the HR professionals, all these people coming together, collaborating, cross-referring is going to produce, most importantly, an optimum outcome for the client, but equally importantly, really, lower risk for professionals as a group. So the danger isn't any longer just aggressive tax planning as it perhaps used to be. It's administrative failure, scope creep, ambiguity in engagement letters, things falling between the cracks. As time goes on through 2026, these things become more and more important. So what should we be doing about all of this? So it's about conversations with our clients, and as we've said, ideally a round table with a number of different professionals in the room. So accountants might be talking to clients about fiscal drag. So, are they paying more tax, even though tax rates haven't increased, and what can be done to mitigate that? To business owners, we might be talking about, is extraction still optimised? 5 years ago, you might have put together a profit extraction strategy. Is that actually still the best way of doing it? potentially not, because of the changes and the creep that we've talked about. Does succession need to be accelerated? Do we need to think about the IHT? Is it more important to get children in the business now, to pass assets over earlier, to pass shares, to pass cash over at an earlier point? Are transaction structures reform proof? What if that main rate of capital gains tax does go up to 28%, as in our example earlier? What would that mean for the amount of money that your client is actually going to realise from selling their business? Is there a timing sensitivity? Do they want to accelerate their exit to guard against that? And are we collaborating early enough? So these are strategic advisory questions, and it's really, really important for advisors to be getting together, collaborating to get the best result for their client, which at the end of the day is the most important thing for all of us. And those conversations need to be strategic, not technical. So we can't just say to a client, if you sell your business, you're going to pay business asset disposal relief 14%, and then you're going to pay 28% on the balance. We need to be talking about strategy. When do you think you might want to sell? What might happen by then? If the tax rates have increased, what would that mean for you? It has to be strategic. Cross-disciplinary, as we've just said, you need to get everybody around the table to get the best result for the client. Commercially aware, for example, there's no point rushing an exit, is there, if the company is growing in value, and actually delaying it might realise a better result for the client. We have to be commercial, and we can't let the tax and the sensitivity drive the commercials. And most importantly, everything has to be focused on client impact and advisory opportunity. How can we get the best result for our client? What is the opportunity for us as advisors to really add value? And I think in this digital and AI age, that is where we add the value, isn't it? AI can do calculations. It can, it can even tell people what tax law is. But what it can't do is provide that comfort to the client and that nuanced approach of bringing everything together as advisors, which we can. So in terms of final thoughts, we've been talking today, haven't we, about 2026 and the tax trends and the risks. And the risk isn't a dramatic change. We don't know what's going to happen in various government announcements, but we haven't been told there's going to be any dramatic tax increase. But there is going to be a gradual erosion of value because of the effects that we've talked about today. Advisors need to be forward-looking. It's easy to ignore gradual change, isn't it? But advisors do need to be aware of it, forward-looking and proactive. And as I've said, proactive conversations are where we can really add value. The firms that do best for their clients and for themselves are the ones that are proactive, and they react the most quickly, not just to sudden shock announcements, but to structural drifts. What's happening, what's the gradual change. And I think the trend in 2026 is that it's going to be gradual change, and we need to be on top of it, aware of it, and responding proactively to help our clients. So that's the end of my slides for today. We've got some more time. If anybody has any questions, would like to put them in the chat, I am very happy to answer. Otherwise, thank you for listening. Please do get in touch if you have any questions. As I say, this has been a different format to our previous sessions, which have been very technical. This has been much more around kind of trends, risks, strategy. So I'm really interested to know if you like that, or if you prefer the technical updates. Please do let me know. My email address is on the screen. You can find me on LinkedIn. I'm regularly on LinkedIn, and look forward to hearing from you. So we don't have any questions at the moment. So thank you for listening. It's great to have you join us, and please do join us next month for our session, which will be on hidden tax risks in M&A transactions, and that will be sent around in our newsletter and publicised on LinkedIn in due course. So thanks for joining, and we will see you next month.